Welcome back to the deep dive.
Great to be here.
Whether you are a seasoned entrepreneur with, multiple companies under your belt, or you're just starting to strategically accumulate your wealth, this deep dive is tailored specifically for you.
Absolutely.
We are looking directly at you, the learner, because today we are exploring something that could save you from making incredibly costly financial mistakes.
And unlocking some of the most powerful wealth preservation strategies out there at the same time.
Right. Today's topic is South African business trusts. We are pulling from an incredibly detailed newsletter that exposes the most expensive misconceptions out there about trusts.
It's a goldmine of information.
It really is. And we're pairing that with some brilliant insights from the website of Lumka Sturman. She's a highly regarded South African trust consultant.
And I think we need to be clear right up front. The goal here isn't to scare you away from trusts.
No, not at all.
In fact, it's the exact opposite. Trusts are incredibly positive, powerful tools for building and protecting generational wealth. But they require intentional design and active management.
They aren't just magic wands you wave over your house.
Exactly. You might think you have your financial life perfectly compartmentalized, but there are hidden traps in these legal structures that catch even the smartest business owners completely off guard.
Okay, let's unpack this, because it is wild how many brilliant founders, people who know every single metric of their business inside and out, will just sign trust paperwork, pay the setup fee, and assume they are protected for life.
It happens every single day.
So our mission today is to cut through all the confusing legal jargon and show you how to build what Lunka Sturman calls an asset protection fortress.
I love that term.
Me too.
Yeah.
It is all about separating your ownership from your risk, ensuring that the legacy you are working so hard to build is actually secure.
But that assumption of automatic protection that you mentioned, that is precisely where the danger lies.
Right.
And that brings us to the first major misconception. The idea that simply moving your assets into a trust makes them instantly untouchable by creditors.
Yeah, people think, well, the trust owns my house now, so if my business goes under, my personal wealth is completely walled off.
Right. They think it's a vault they can just lock and walk away from.
Wait, let me play devil's advocate for a second.
Sure.
If I am the one who built the wealth, and I funded the trust, and I built the business, why shouldn't I be the one making all the decisions? Why do I need to jump through hoops to prove the trust is separate from me?
Because South African courts are not easily fooled by paperwork if the reality doesn't match the legal structure.
Meaning what exactly?
Meaning if you treat the trust like a personal bank account, the courts will absolutely pierce that trust. They look for what is called an alter ego.
An alter ego.
Yes. If you set up a trust, appoint yourself as the main trustee, make yourself the main beneficiary, and continue to treat the assets as your own personal property without consulting independent trustees, the court will simply disregard the trust entirely.
Wow. And the sources share this wild cautionary tale about the Badenhorst family divorce.
Oh, the Badenhorst case, yes.
Mrs. Badenhorst was arguing that the family trust's assets shouldn't be part of the divorce settlement because technically the trust owned them, not her husband.
But when the court looked at how the trust actually operated, they found that Mr. Badenhorst treated it like his personal piggy bank.
He lived in the trust property.
He drove the trust's cars, and he made every single financial decision without ever holding a meeting or consulting the other trustees.
So he was just doing whatever he wanted.
Exactly. The court concluded the trust was just his alter ego. It was essentially a legal fiction, so they threw those trust assets right into the estate division.
That is a harsh wake-up call. And it's not just about who controls the assets, is it? It's also about the timing of when those assets are moved.
Timing is everything.
There's another case in our sources, the Van Zyl case. This construction company owner transferred his house and his investment properties into a trust right before his company went insolvent.
He saw the writing on the wall.
Exactly. He was anticipating the crash and trying to hide the assets from creditors who were coming after personal guarantees he had signed.
And the courts see right through that kind of maneuvering. They found the transfers were made specifically to defeat creditors.
And ordered them to be reversed.
Yep. He lost the business and the assets. You simply cannot use a trust to defraud creditors. The trust is a separate legal entity, not a hiding place.
Let's pivot to the positive here, because there is a very deliberate, effective way to do this. This is where that concept of the asset protection fortress really shines.
It's a great concept.
The golden rule of the fortress is profoundly simple. Your trust owns the assets, and your company carries the risk.
What's fascinating here is how this simple timing of transferring assets and maintaining genuine independence is the true secret to the fortress. If you build it correctly, well before any storm hits, it holds up beautifully.
Like the Pretorius family. They are the perfect success story for this in the newsletter.
They did everything by the book.
They set their trust up correctly, 15 years before any business trouble ever occurred. 15 years.
That proves intent.
Right. They used independent professional trustees, they formally documented all their decisions in minutes, and they treated the trust assets as genuinely belonging to the trust.
Not to themselves.
Exactly. So when Mr. Pretorius eventually faced business difficulties and creditors came knocking, the trust held strong. The creditors failed to reach those assets because the fortress was real.
That wasn't a sham. It was a completely separate, functioning legal entity. And that peace of mind is invaluable. But you have to put in the work to establish that separation early on.
Definitely. But protecting assets from creditors is really only half the battle.
Oh, absolutely.
Because a lot of founders set up these bulletproof fortresses and then accidentally trigger a tax nightmare. They just assume trusts are automatically tax-free. You hear it all the time. Oh, you're making good money. You need a trust for tax reasons.
It is a deeply embedded belief in South African business culture. But the tax landscape has changed dramatically.
People are in for a shock.
Let's look at the hard numbers. If your trust is simply accumulating income, it is taxed at a flat rate of 45%.
45% flat.
Yes, that is the highest marginal rate. And capital gains tax, or CGT, for a trust sits at an effective rate of 36%, which is double the maximum rate for individuals.
Double. That is staggering. And our sources have some brutal cautionary tales about this. Take the Patel family.
That one is tough to read.
They funded their trust back in 2008 with a 5 million rand interest-free loan to buy investment properties. They thought they were being incredibly tax efficient.
But they completely missed a massive legislative change. Section 7C was introduced to close exactly this kind of loophole.
Can you break that down simply?
Sure. If you lend money to your trust but don't charge interest, SARS sees that free interest as a hidden donation to the trust. So they calculate what the interest should have been, and they tax you heavily on that amount. It's a deemed donations tax.
And because the Patel's accountant hadn't flagged it, this deemed donations tax had been quietly accumulating since 2017.
Just compounding in the background.
Until a new accountant finally reviewed their setup. And the Patels ended up owing over 400,000 rand in taxes, interest, and penalties.
It wiped out any perceived benefit they thought they had.
Completely. And then there's an Nkosi family who got hit by that brutal capital gains tax rate.
Yeah.
They sold a property that the family trust had held for 20 years. They made a great profit, nearly 3 million rand.
Good for them.
But because the trust held the property, their CGT liability was roughly 1.08 million rand.
Yeah.
If they just held it in their personal names, they would have paid about 540,000 rand.
So the trust structure literally cost them over 500,000 rand in extra tax.
That is painful.
It is. Those stories hurt, but they highlight why guesswork doesn't work with trusts. You have to calculate the real numbers. Now, this doesn't mean trust can't be tax efficient.
Right, they can be.
They absolutely can be, but it requires highly calculated planning.
So how do we make the tax landscape work for us instead of against us?
Well, income splitting among adult beneficiaries in different tax brackets can still be highly effective, provided you are making genuine, documented distributions.
So no fake paper distributions where the money doesn't actually move.
Oh, definitely not. SARS auditors will catch that immediately. The money has to move. There are also specific structures, like special trusts for disabled persons that receive highly preferential tax treatment.
And we really can't forget the estate duty benefits.
That is a massive one.
By placing an asset in a trust, all the future growth of that asset happens outside of your personal estate. You're essentially capping the value of your estate at the time you transfer the asset, which can save your family a fortune in estate duty down the line.
Exactly. But it requires intentional, active strategy. And speaking of what happens down the line, that brings us to the third major misconception.
Right.
It's this dangerous idea that a trust just automatically handles your estate planning. People assume that because the assets are in the trust and the trust continues after you die, succession is totally sorted.
It's a logical assumption, but a legally flawed one. Having assets in a trust doesn't mean they'll automatically pass to the people you want in the way you want.
Everything is dictated by the trust deed.
And the problem is, people set these up decades ago and never look at them again. It is like updating your phone's software, but leaving your computer running on Windows 95. The systems aren't talking to each other anymore.
The Jobert family story illustrates this perfectly.
Oh, this one is crazy.
Mr. Jobert set up his trust in 1995, naming his wife and 2 kids as beneficiaries. Decades pass, he has a 3rd child, and he unfortunately becomes estranged from one of his original children.
Okay.
So he does what you're supposed to do. He updates his personal will to reflect his current family dynamic and his current wishes.
But he forgot to update his 1995 trust deed.
Hmm.
So when he passed away in 2024, he assumed his updated will would control everything.
But trust assets are not part of your personal estate. They are governed entirely by the trust deed. So, according to that 1995 document, his estranged child had equal rights to the trust benefits, and his youngest child, who wasn't born yet in 1995, had no rights at all.
Here's where it gets really interesting. The trust deed entirely overrides a personal will when it comes to trust assets. You can write whatever you want in your will, but if the asset lives in the trust deed is the only thing that matters.
Precisely. Your will handles personally owned assets, and your trust handles trust-owned assets. They must speak to each other. They must be coordinated as an integrated plan.
That have total sense.
And another critical factor is control. Who actually takes over the trust when you die?
The Blueson Trust story is terrifying on that front. The founder died without specifying who takes control of the trust afterward.
A mistake.
The trust deed just vaguely said surviving trustees could appoint new ones by majority vote.
That vacuum of power led to an absolute nightmare. His children, who were both trustees and beneficiaries, disagreed on everything. One child managed to stack the board with allied trustees and vote to distribute the assets primarily to herself. Unbelievable.
The other child took it to court. It descended into a costly legal war, and legal fees consumed a huge portion of the family's wealth.
But when done correctly, a properly maintained trust is the ultimate tool for generational wealth planning. Think about the Master's Office for a second. That is the government body that oversees deceased estates in South Africa.
It can be a very slow process.
Going through them can freeze your personal assets for months, sometimes years. A trust completely avoids those costs and long delays because the trust never dies. It immediately protects your dependents, provided the documents are actually up to date and clearly define succession.
It's about recognizing that a trust is not a stagnant piece of paper. Which brings us to the 4th misconception, the set it and forget it mentality, and the assumption that all trusts are exactly the same.
We call this part the engine room, because a trust requires ongoing administration to keep running. You can't just buy a generic trust off the shelf, throw your assets in, and never look at it again.
No, you really can't. And to be fair to business owners, this often isn't laziness. It is just compliance fatigue. Founders are incredibly busy running their actual companies.
That is very true. But that neglect is still incredibly risky. The Kumalo family found this out the hard way. They transferred their family home and investments into a trust in 2010 and then did absolutely nothing else. No annual meetings, no minutes recorded, no separate bank accounts. They even ignored the new beneficial ownership filing requirements that came into law recently.
So when SARS eventually audited them, there was zero evidence that the trust actually functioned as a trust.
Exactly.
SARS hit them with penalties for noncompliance, but the worst part. The audit report officially noted that the trust appeared to be an alter ego.
Which is devastating.
They forwarded that finding to SARS collections, basically putting a giant target on the Kumalo's backs for any future creditor issues.
And it is not just about the administrative upkeep. It's about the original design of the trust itself. Using a generic template is asking for trouble.
Give us an example of that.
Well, the Ferreira family wanted asset protection, but they got a generic discretionary trust that gave Mr. Ferreira so much control, it offered almost zero real protection against creditors.
Because it looked like an alter ego again.
Exactly. Then there was the Molef family, who wanted a trust for estate planning to protect the surviving spouse. But their generic trust deed actually restricted the widow's access to the capital, leaving her in a terrible financial position after her husband died.
So we have all these traps. Alter egos, Section 7C deemed donations, outdated deeds, generic templates. How do we proactively fix this?
You have to treat your trust like a living, breathing business. It requires annual trustee meetings, separate financial records, and active administration.
It's an ongoing commitment.
It is. And crucially, if you are listening to this and thinking, oh no, my trust is a generic mess, don't panic. Trust can be changed.
That is a relief.
If a trust has issues, the deed can often be amended, the structure can be updated, or you can even establish new trust and transition assets. Proactively fixing a problem now will save massive costs and headaches in the future.
Which brings us perfectly to our final segment, bridging the gap with a trust consultant. Because managing all these details, the independent trustees, the SARS compliance, the Section 7C calculations, the alignment with your will, it's a massive undertaking.
It's practically a full-time job.
And that is exactly why business owners bring in an expert to do the heavy lifting. This is where we introduce Lumka Sturman.
Lunka is a dedicated trust consultant and asset protection specialist. What's really unique about her approach is her exclusive focus. She isn't a generalist attorney who does a bit of everything.
Right.
She specializes exclusively in trusts for South African business owners, specifically targeting those with a turnover between 1 million and 50 million rand.
Her entire practice is built on three core values: integrity, education, and excellence. And looking at her website, she is very focused on concrete educational solutions. She conducts what she calls fortress checkups to find all those hidden red flags we've been talking about before SARS or a creditor finds them.
She structures her offerings depending on where a business owner is in their journey. For new owners, she offers a foundation audit. This looks at your exposure risk and gives you a clear roadmap.
And if you need more,
There's the Asset Protection Blueprint, which actually maps out your asset flows and provides a custom trust and company structure. And for the business owner who wants the absolute gold standard, she offers a full bespoke fortress setup with annual maintenance.
to give you an idea of what this level of specialized advisory costs, Lumka's foundational audits start around 25,970 Rand, scaling up to 47,900 for full annual maintenance.
Which honestly is a bargain when you look at the alternative.
Absolutely. When you compare a 50,000 Rand annual fee against a million Rand capital gains tax mistake like the Nkosi family made, or losing your entire estate like the Van Zulls, the ROI on compliance becomes incredibly clear. She acts as the engine room for your trust so you can focus on running your business.
It is also important to note that she doesn't replace your existing accountant or attorney. She collaborates with them. She brings that highly specialized trust expertise to your existing advisory team to make sure everything is watertight.
If you are a South African business owner and any of these cautionary tales made you realize your legal structures might need an update, you need to visit her website. It's www.limkasturman.com. She even has a book available on Amazon if you want to dive deeper into her methodology before booking a session.
If we connect this to the bigger picture, working with a dedicated consultant like Lumka transforms your trust from a stressful, confusing liability into an incredibly powerful, legacy-securing asset. It stops being a source of anxiety and becomes the literal fortress protecting your family's future.
To recap our journey today, we've learned that a trust is not just a piece of paper you sign and forget.
Far from it.
It requires a genuine separation of ownership, strategic tax planning that looks at the real numbers, estate documents that are perfectly aligned, and active, ongoing administration. Your business is there to protect your income, but a trust is there to protect your wealth.
You have to treat them with equal respect and attention.
So we want to ask you directly, if a creditor challenged your trust tomorrow, would it survive scrutiny? Are you truly protected, or are you operating under an expensive misconception? So what does this all mean?
Think about the most valuable asset you currently own in your personal name. Now imagine a scenario where your business faces an unexpected, catastrophic lawsuit tomorrow. Is the peace of mind of knowing your family's home and future are entirely insulated from that chaos worth the effort of auditing your legal structures today? Your legacy is being written right now. Make sure it's kept in a fortress, not a house of cards.